During the 1970s, gold's bull run from $35 per ounce to a high of $850 per ounce for a gain of 2,329% came during a time of rising interest rates. If we go by gold's low of $250.95 per ounce in 2001, if gold makes the same percentage gain during its current secular bull market, gold could easily reach $6,200 per ounce before its bull run is over. The best way to gauge inflation is to simply look at the price of gold. Gold is the most stable asset the world has ever seen. In 1970, you could have bought a nice men's suit for 1 ounce of gold or $35. Today, you can still buy a nice men's suit for 1 ounce of gold, but $35 won't even buy you a nice t-shirt. Although the Federal Reserve doesn't admit it, they secretly watch the price of gold like a hawk. If the price of gold melts up too quickly, it's a sign that the dollar bubble is coming to an end. The silver market provides a window into what is happening in the gold market. Because the silver market is minuscule compared to gold, silver prices are usually very volatile and swing both to the upside and downside by much larger percentages than gold. Based on recent events in the silver market, it appears as though the Federal Reserve bailouts of Wall Street may have been in part to artificially suppress precious metal prices.
On March 14, 2008, the very day Bear Stearns failed, we saw silver hit a multi-decade high of nearly $21 per ounce. Bear Stearns was on the verge of having to cover their short position, which could have easily sent it to $30, $40, even $50 per ounce. Instead, we see the Federal Reserve orchestrate a bailout where J.P. Morgan acquires all of Bear Stearns' assets with the backing of the Fed. Next thing we know, J.P. Morgan, they acquire the silver short position of Bear Stearns, manipulate the price to below $9 per ounce.
The CFTC's own reports of November 2009 show that just 2 banks held 43% of the commercial net short position in gold and 68% of the commercial net short position in silver. In gold, these 2 banks were short 123,000 contracts, but long only 523 contracts. And in silver, they were short 41,000 contracts and long only 1,400 contracts. How improbable is that these 2 banks attract most of the investors who want to sell short?
J.P. Morgan is now short approximately 30,000 silver contracts, representing 150 million ounces of silver. This is one of the largest concentrated short positions in the history of all commodities, representing 31% of all open COMEX silver contracts. Another 7 commercial banks are short a total of 35,000 silver contracts, combining for a total commercial net short position in silver of 65,000 contracts. This means commercial banks are now short 325 million ounces of silver that they will eventually have to cover by purchasing these 325 million ounces of silver back in the open market. This could create the largest short squeeze in the history of all commodities. Since the beginning of World War II, the world has consumed more silver for industrial uses than it has produced from silver mining and recycling. 70 years ago, the world had 10 billion ounces of above-ground silver inventories. Today, it is estimated that there are only 1 billion ounces of silver inventories left. Silver is currently only 1.5% the price of gold, despite the fact that above-ground inventories of gold have become much more plentiful than silver. In the first quarter of 2010, the U.S. Mint sold 9,023,500 American Silver Eagles, the most since the coin debuted in 1986, and up from 8,299,000 sold in the fourth quarter of 2009. All U.S. silver mines combined are currently producing only 40 million ounces of silver annually. This means that the U.S. needs to use almost all of its silver production just to keep up with the demand for American Silver Eagle coins.
The fact of the matter is this. The gold to silver ratio of 64 would not be possible unless silver was being held artificially low through manipulation. I don't believe it is possible for the silver that J.P. Morgan is short to be backed by physical silver. Most likely, J.P. Morgan is naked shorting silver by selling paper silver that doesn't physically exist.
Are you concerned that the shorts will not be able to deliver if called upon?
No, I'm not at all concerned. For one thing, it's been persistently that way for decades. Another thing is that there are any number of mechanisms allowing for cash settlement. Precious metals are financial assets, and like currencies and T-bills and T-bonds, they trade in the multiples of 100 times the underlying physical.
What Mr. Christian fails to realize is that investors around the world that are holding paper silver contracts believe they actually own the physical silver. There's going to come a time where these investors don't want cash settlements in US dollars, they're going to want the physical silver itself, and this is going to result in a COMEX default.
In June of 2007, Morgan Stanley agreed to pay $4.4 million to settle a class action suit with brokerage clients who bought precious metals and paid storage fees, when in fact it was alleged that Morgan Stanley wasn't physically storing their gold and silver at all. It's not out of the realm of possibility that the Morgan Stanley situation has evolved into an epidemic of banks selling silver they don't have. During the past couple of months, 18.5 million ounces of silver have been taken out of the silver ETF, SLV. With silver prices up nearly 20% during the same time period, it's unlikely that SLV investors have been selling. The withdrawals from SLV have taken place at the same time as large inflows have come into COMEX warehouses. This means we could be seeing dealers who are scrambling for physical silver to deliver to their wholesale customers. If they are having to take their silver from SLV, it could be a sign that very little silver remains in unreported silver inventories. A major silver short squeeze could be imminent. Based on the government's own CPI index, silver's all-time high in January of 1980 of $49.45 per ounce would equal $138 per ounce in today's dollars. If you account for how the government's CPI index understates inflation, silver's real inflation-adjusted high in January of 1980 was $440 per ounce. If we see a COMEX default and a short squeeze as investors around the world demand physical silver, the price of the physical silver could rise astronomically from its current level of $18 per ounce. Based on gold's current price of $1,150 per ounce and the historical gold-silver ratio of 16, a silver price of about $72 per ounce could be realistic as soon as JP Morgan's manipulation comes to an end.